Thank you, and I'm delighted to be here. And I'm glad I caught the last previous presentation. We've never owned Stella Jones, but maybe I can start my talk by saying, okay, let's assume that you decided you like Stella Jones, you want to buy it. I think one of the most important questions that it seems that few value investors or any investors ask is, how much? How much would you buy? And so as I go through my presentation, I think that one of the things that we've been told by some experienced investors who look at various funds around the world is that they don't often see our approach to what I call portfolio construction. In terms of deciding once you are going to add a company, how much do you add? And so the other point that I'll make is just, as you mentioned, that I was at Ivey. I was at Ivey in 1984. I graduated in 84. And that was probably the height of the efficient market hypotheses. So when I came out of school, I just took it as a given the markets are really efficient. I didn't go into investing, I went into mergers and acquisitions. So as an advisor, it didn't take me long to realize the markets are terribly inefficient. And so in a sense, as I talk about our approach, we have what I would call the strong form of the inefficient market hypothesis. We think public markets are wrong virtually all of the time. So with that, let me go through a little bit of an overview of Turtle Creek. I'm sure none of you have heard of us before, but we have been operating for almost 17 years. We started in October of 1998. We're a long only, and that's stressed, we don't short stock, so we're a long only, investing in North American public companies. And as George mentioned, prior to Turtle Creek, with my partners, we did set up and run a large private equity fund. So we have that background, but we don't do private equity and never have in Turtle Creek. Now it's primarily Canadian companies, but that's not a precondition. So it happens, it's just simply the fact that we're based in Toronto, and I'll talk about how we identify our companies. And it's the case that so far in the life of our fund, we've owned 80 companies, and 70 of them have been head office in Canada, and 10 have been head office in the US. But we think that's an artificiality. Most of our companies operate globally, so we don't differentiate between Canadian and US companies. And I'll emphasize or mention that we've never owned an oil and gas or mining company, so we've never owned basic resource companies. We've never owned any of the big banks in Canada, and a lot of our Canadian investors say, well, what's left? Well, in fact, there's about a third of the market, or 40% of the market, and there are some terrific companies, and Stella Jones is one of them. We've never owned it. We don't own small cap. We're not focused on smaller companies. The average market cap of our companies is around $7.5 billion. And the next point's really important. When I want to spend most of my time today talking about portfolio construction, because when I thought about what would I say to you, you've heard a lot of things, I'm sure, this week, a lot of things about analysis of companies. I think that one of the things that we do that is uncommon is spend a lot of time thinking about portfolio construction. And so what I would describe as an artificial constraint that we have is that we force our fund to have 25 holdings. And that's a really important point, because once you create that need to have 25 holdings, you can then think about, you want to add a company, what's the right percentage that it should be in the fund? After that, we don't have any constraints. If we decide that of the 25 holdings, one should be 13%, then it'll be 13%. In fact, our biggest holding today is 13% of the fund. And we're about $1 billion of assets under management. So we're not a small fund. We manage a reasonable amount of money. So that's the overview. And I don't know that this is a good idea, but I want to get your attention and I want to talk about our approach. So I'm going to then go on to returns. But I ask you to look at the heading of the slide. Risk reduction leads to higher returns. We didn't set out to make the returns we've earned. We simply take an approach that within the constraint or parameter of having 25 holdings, we want to take the least amount of risk. It's really that simple. If you look at the slide, the black is the broad market. In this case, it's the S&P 500. the S&P 500 in Canadian dollars and a common currency, including dividends. So it's the total return you would have earned just owning the broad market. And so we caught the tail end of the dot-com bubble. And so this is taking our 17 years and breaking it into the 5 distinct market periods that we've lived through so far. As I say to our investors, we think we've pretty much seen everything in terms of an historically high valuation level at the end of the 90s, a pretty grueling bear market in the early 2000s after a hangover from that valuation level, call it maybe a typical bull market in the mid-2000s, a epic financial panic, and now what has turned out to be an historic bull market. And so if you look at how we did in each of the periods, and I'll first point out, our best time for us is when the markets are in turmoil. And you'll see that as I talk about our approach. But in the first segment of the period, we significantly outperformed the market. The market was up 30–40%, we were up 300. But maybe, in my mind, more impressively, when the market was down 40% over the next 2.5, 3 years, we actually were up about 50%. We outperformed in the bull market in the mid-2000s. We didn't outperform in the financial panic. We own public companies. We're not hedged in any way. And if there's another financial panic, the share prices of our companies will follow along with the market. However, we recovered our share price of our companies and our unit price of the fund recovered a lot faster than the broad market. We actually recovered all of that decline by the end of 2009. So within a year, we were back to an all-time high, and we outperformed somewhat in the last few years. And when you add all of that up, you get a pretty anemic result only in the broad market in the last 17 years, and our returns of growing $1 to $45 over that period. But again, it's not an objective. We are simply trying to minimize risk within the parameters that we've set of wanting to own companies and not lending to companies, not wanting to own gold bullion at any time, and preferring not to be in cash. So we were not fans of cash. Although I will say that in early 2000, we had as much as a third of the fund in cash. It had nothing to do with the market, a market call. It had to do with our inability to find cheapness at that time compared to cash. So that's the return history of the fund. And now I'll talk about how we've done that. And there are really 3 things that we do. And I do want to spend a lot of time on portfolio construction. But the 3 things we do, first we identify highly intelligent organizations. We don't believe in terrific businesses. We actually believe in terrific companies. And I would theorize that without the fellow who came in 2005 or 2003 at Stella Jones, that same company would not be where it is today without that management. Our view is it is about management. So we like to think of terrific companies, not terrific businesses, because there are 2 companies in our 25 company portfolio today that if you go back enough years, we would meet them and think this is not a terrific company by any stretch. But through either a proxy fight or without a proxy fight, management changes and cultural changes, we think they're highly intelligent organizations now, and they're in the portfolio. There are other companies that we used to own that over time have become unintelligent through bureaucratic time, through management changes, just through not reacting to the competitive environment. So it's a critical first step. We'd like to build our portfolio from those types of companies. We want to own highly intelligent but also honest management of companies because, and as a connection to that, companies that don't need the public market, and that's a really critical point. We don't own companies that have to raise a bunch of money from the market to pursue their business plan. That they make enough money, they happen to be public often because the original owners decided they wanted to diversify their own portfolio, diversify their risk. And so it's not to say that the companies we own don't ever issue equity, but they don't have to. And if the price isn't attractive, they won't. And in a lot of cases, when the price is especially attractive the other way, they will buy back their stock. So building a portfolio from those types of companies is a bit of, call it having the wind at your back for all the things that you might do. But where we spend most of our time every day is in valuation. So absolutely what you would have learned this week in class and talking about cash flows and the things I heard in the last half hour, those are the things that we do. And while we may look at a lot of things like return on capital and how the company's done in the past, ultimately what we're trying to determine, we're exclusively focused on the cash flow from the company, all the way back to the shareholder. So while our companies are public, we don't want to be reliant upon the public market to recognize value. You'll never hear us complain, oh, this is so cheap, how come no one else realizes it is so cheap? We own our companies for the cash we're going to get back from them today. So to give you a framework, today we think for the aggregate portfolio, roughly the net return for the next 10 years that our investors will receive, nothing to do with share prices, but from the cash that will come back to the companies, from the companies we own, through regular dividends, special dividends, share buybacks, is about 15%. And when you own a portfolio like that, you don't want to be in cash. But that's why we don't want to be in cash today. So we spend most of our time, as I said, focusing on this cash flow, how much cash coming from our companies, all the way back to the shareholders. But there are three things in this valuation approach that I wanted to quickly touch on that I think are important as to how we view the world. Complexity, uncertainty, and then balance. This is our approach. The complexity is, well, the world's really complicated, and having, prior to Turtle Creek, sat on and owned, they had control positions in some decently large companies, a dozen of them, you end up with an appreciation of how complicated companies are, how complicated the world is, and the idea that you can do an assessment, read an annual report, and figure it all out is naive. You never will. So you're dealing with imperfect information. You're dealing with uncertainty in the world all of the time, so you have to think probabilistically, and that's our approach. We recognize we're going to be wrong all of the time. And this is back to the third point now, balanced. And maybe this is call it a differentiation of our approach versus other value investors, per se. I've heard many value investors speak, and they describe how conservative they are when they create a forecast. And I listen to that and I think, that's not us. We're not conservative. Think of us as embracing the growth opportunities that a company has. And by the way, we own companies that have no growth opportunities, so we're happy to own them. But when companies have great growth opportunities, we include that in the forecast. So think of us as trying to get that median. If you think of a big range of future outcomes for a company, there's only going to be one. We're trying to catch the middle. We're trying to be as equally too high as too low. So I stress that balanced approach, because if you don't have a balanced forecast for each of your companies, you can't then go to the next step, which is portfolio construction. If you've been excessively conservative, so that you can say, I have a margin of safety that's so huge, but that won't tell you how much to own. It won't tell you, okay, great, it's really cheap, and definitely you should own it, but should it be 10% of your portfolio or 1% of your portfolio? And through this approach of, call it apples to apples across all of our holdings, we then can move to the portfolio construction step. So when we think about how much to own of each of our companies, the biggest driver, of course, is what's the cash flow? How much return will we earn based on today's price from the cash paid back to us from the company? And if a company will pay you 20% returns versus 10, of course you want to own more of the 20%. But frankly, the 20% could turn out to be 8 in a bad scenario, and the 10% forecast could turn out to be 14 or 18. So it's back to this idea of recognizing how uncertain the world is. And then we've, over the years, developed a way, and it's imperfect, it's constantly, we're tweaking it, but it's been consistently applied since we started, as to a whole host of other factors as to how much of a company we want to own, the relative risk of each company, which we think of as dispersion of those forecasts, the quality of management, are we aligned with are they really trying to make money for shareholders, or only kind of trying to make money for shareholders? But through all of that process, we end up with what, to the best of our ability, is an optimal portfolio. So today, our biggest holding is 13%, as I mentioned. Our smallest holding is 0.4%. We actually probably think that 0.4% holding is a more terrific company than the 13% company. So this is where the value approach, our philosophy comes in. We're focused on the cash flow, i.e. the margin of safety of the holdings in our fund. But then here's what happens in the public market. And the wonderful thing compared to when we used to be private equity, the prices change every day. So there is not a day that goes by, and the last couple of days have been a little more turmoil in the Canadian market. So we've done even more, but there is not a day that goes by where we aren't adjusting our holdings. Little bits across various holdings in response to the changing prices. So if you think of our approach and imagine, come back to take a very simple example. You have two holdings. They both have a 15% expected return. They're both equal risk, great management, all similar. You might have half your money in one and half your money in the other. But then imagine the next day, one company's share price goes down by 10% and the other goes up by 10%. In the market, that can happen fairly often, as you know. And almost always, nothing's really changed. So if you do nothing in that portfolio, what's happened? The company that's now riskier and has a lower return profile is a bigger weighting in your fund. And so you need to fix that. And that's what we do every day. Take that two-company example, extend it to 25, and then recognize that each company is different, each company is a different risk. But that fundamental thought, which is you need to scramble all of the time to react to the noise of the public market, and I stress the noise. We don't believe there's any informational content in share prices moving around. There's informational content in news from a company, quarterly results, and anything else they might announce. But we don't believe there's any informational content in the share price going down. That's not necessarily indicating bad news. It's just, for us, it's an opportunity. In fact, today, our second largest holding is down 5%. We view it as an opportunity. And so, from what I'm describing, as you might expect, we've been buying a lot of stock today in that company. And so our term for this is continuous portfolio optimization. It's a key source of our outperformance. If you think of our returns having been 26%, think of a blend, for example, of the S&P 500 and the TSX, the Canadian market, has been around 6%. That's a big outperformance. Most of it comes from not being strictly a buy and hold. Our philosophy is we intend to be a buy and hold, but then if the relative prices change, you can't be a buy and hold. You have to react to those relatively changing prices. So in a way, think of it as an overlay to a buy and hold. But really, I think what's most helpful is to give you a hard example, a case study, if you will. So this is there's a few slides of build, so I want to walk through each one of them. This is a Canadian company based in Waterloo, Ontario, called OpenText. They're a software company. They happen to be a world leader in helping large, think of the global 2,000 companies, deal with all of that unstructured data inside of their intranets, inside their companies. When they started, even before '98, back in the early '90s, and I don't know if anyone will remember this name, but they decided not to compete with Alta Vista. This was a technology out of the University of Waterloo that was, I think, probably pretty good technology for a search engine, but they concluded that going toe-to-toe with Alta Vista might not be the best strategy, and what about focusing on intranets inside corporations, which in hindsight was a really good choice. And which also stresses a point, we never sit around and say, helping companies deal with unstructured data in the way that SAP helps companies deal with databases and structured data, that's good business. Let's go find a company that does that. We're never thinking that way. The entity has to exist. Typically, we have to find it, we have to identify it, and then we'll go to school on that company. We'll learn about the industry and about the company through their eyes over time, which I think is something we've done over quite a long period. One of my partners has been to every user conference that OpenText has had with their customers for every year since we've owned the company, and he knows it really well. And we spend time in aggregate. We've spent a lot of time with management at all levels of the company over the years. So this line, and I saw this similar line in a previous presentation, this is our intrinsic value. And importantly, for us at least, we've never changed our weighted average cost of capital. And in fact, we don't think of it as a weighted average cost of capital. We use a 9 to 10% discount rate. And if we used an 8 to 10 or a 6 to 8 or a 12 to 14% discount rate, it wouldn't change our portfolio. It wouldn't change the construction. So in a way, remember, what we're really thinking about is expected return. And today the expected return is 15%, but if it was 12%, we'd still own the companies that we own. And so, but you can see over the years, the intrinsic value of this company has risen, and it's risen at a rate of 16% a year. So we got the first part right. We identified a highly intelligent, value-creating corporation to own. And the other thing I'd point out is that, well, it's only happened once. Recently, we're willing to take our views of value down. If you look carefully to the very far right we've recently reduced our forecast on the company. So, although if you think about a company that doesn't pay dividends, and this company has never paid dividends until recently, and even now it's a small dividend, if you're right about your forecast, it should grow in intrinsic value, and it should grow at 10%. In fact, it's outgrowing our original expectations. But then here's the beauty of the public market. Look at the share price. Look how much it's moved around. And assume for a second that we're reasonably right about our forecast. Assume for a second that we're reasonably right about, call it enterprise value or intrinsic value at about a 10% discount rate. Look what's happened to the share price. This is in 1999, it got absolutely crushed down to very low levels. And I'll point out, this is a log scale, so it kind of understates the swings in a way. But otherwise, it's hard to read. And then in 2000, it actually went well through our estimate of intrinsic, and see how it's bounced around over the years. So, and then if you look at the left y-axis, you can see 5, 10, 15% portfolio weighting in the portfolio. And so here's the secret to what we do and why we've earned the returns that we've earned. This shows the weighting in the fund. This shows how much of our fund was in this company at various times. And when we initially owned it at a reasonable price, a little bit below intrinsic value, which would mean maybe an expected return of 11%, it was 2-3% weighting in the fund. But then as it got absolutely crushed in '99 because of what we thought and were concluded was a frivolous lawsuit, we made it the biggest holding in our fund that, less, it's hard to read here because so much happened so quickly. It was less than 10%, but it was close to 10%. And then all that happened is the share price went up, and it went up a lot. And we kept selling it down, and even here where it briefly was above 15%, that's a bit of an anomaly. That's never happened in any other time in the fund. But you can see we quickly got the position down, and at times in 2000, we owned none of the company. And this is a terrific company. We've always thought this is a terrific company. But again, it's a reaction to expected returns, and then what else is happening in our portfolio. And over the years, we've fluctuated how much we own. Again, not to make higher returns, but to put our money in the least risky things we can find. And so in the credit crisis, look how we took our position down to 0. It's because the share price of this company didn't go down. But everything else we owned went down. It didn't fall. We didn't worry about why. We simply said, okay, well, we don't want to own this company anymore. We want to own these other companies where the share prices have fallen. But then in 2009, we added to the position, and again, it's fluctuated over time, and going forward, who knows what will happen. We have no idea where share prices are going. We culturally act internally in the company that the market is a complete random walk, and even if we don't believe that, we act that way. We act that way every day. We simply know, in the case of OpenText, I know precisely how much stock we will buy at $48 and $47 and by the way, Today it went to 49 something or 48, and we bought stock today. And are buying stock to try to make this percentage go up now because of where the price is relative to what we think it's worth, i.e. the expected return. And so through that process of trying to take the least amount of risk, being as conservative as we can, being scaredy cats, being terrified, and owning it here because it was trading at cash on the balance sheet. And then you get all the cash flow that they're going to generate in the future. But making sure we don't own it here when other things are much more attractive ends up taking a buy and hold of 11%, which isn't bad for the period that we're talking about, with a 64% IRR, annualized return through this process. And this simply takes a previous slide and adds 3 lines. Not surprisingly, because we use about a 10% discount rate, the blue line, which is intrinsic, is roughly the same as this graph, as this line, 10%. But you can see if you can buy it here, your long-term expected return is 20%. That's happened a few times. And it's never happened with OpenText, but if you could buy it down here, you'd make it an even bigger holding. And that's the approach we're taking every day with all of our holdings. So I can apply this to each of our other 24 holdings. Any time that a holding has been any kind of size in the fund, at any point in time in the life of the fund, we've made money on the position. So we've owned 80 companies, as I mentioned at the beginning, which means we're changing about 4 a year. We're adding 4, taking 4 out. That's the math of over 16, 17 years. And there are some smaller holdings where we've lost money from when we bought it to when we sold it. But anytime we've made something a big holding, and as you'll think of when you look at our approach or think of our approach, something only becomes a big holding because the price goes down. It never becomes a big holding because the price goes up. If the price goes up, we're selling. And it's this attempt to immediately, once you add a company, own the correct amount, drives you to need to sell stock as soon as the price rises. And by the way, drives you to buy more if the price falls from when you first put the initial position on. And this process applies to all of our holdings, and it's what we do every day. I don't know if I have one more quick case study to show that it's not just done once, it's done all the time. And then I'll open things up for questions. So this is another Canadian company based in Montreal. It's a terrific company, not terrific business. It's actually not a very good business, I don't think. It's the CEO of this company took it over close to 20 years ago, and it was a long-haul trucking company based in Montreal, 100 million revenue break-even. Today, it's 5 billion plus, 500 million plus of EBIT, and he hasn't used capital to do that. He's raised money at times, he's paid money back, he's sum it all up, he's actually given over $500 million back to investors, to shareholders. And so we met this company in 06. I didn't want to meet them. It's a trucking company. It doesn't sound very interesting. What's the competitive advantage? What are all the things we worry about? But it's about management, and it's about the way this CEO and his management team thinks about, okay, I've been dealt this hand. I own a long-haul trucking company. What do I do with that? How do I create value for shareholders? So today, he is still the biggest long-haul truck, or now the biggest long-haul trucking company in Canada, but he also is the second biggest, close to Purolator, parcel and courier company in Canada. Canpar, ICS, Loomis, DHL Loomis, all of the other, he owns all of those. He's made over 150 acquisitions over the years. He recently bought pretty much all the rest of the competition in long-haul trucking in Canada, Clark, Contrans, and owns a U.S. long-haul trucking company now. He's the biggest same-day delivery company in the U.S. So when Amazon and Google are doing their e-commerce trials in Manhattan and San Francisco and other places now, his company is one of the 2 or 3 companies that are doing that. It's a remarkable company, not a remarkable business that he's in. And so as we did work on the company, you can see we did our valuation, again, about a 10% discount rate. And then here's what happened. We owned it in the teens initially, and then the credit crisis hit, and then in a way post-credit crisis, by the middle of 2009, when other things that we owned had recovered, this company's share price kept going down. And I mentioned at the beginning that while we went down as much in the credit crisis as the market did, we bounced back faster. All of our share prices of our companies didn't bounce back. It's the things that we did inside the portfolio, and this is an example of it. So you might guess ahead of time, but we bought a lot of stock as the price went down. So we made this at cost, purchasing down to here, which is about as low as $3, made it about 8-9% of the fund, and then we didn't start to sell until $4. So that's unusual for us to let it go up 33% before we began to sell. So it did for a time go above 10%. But the key point is, as cheap as we thought it was, we began selling shares at $4, and by the time it got back to 10, we had sold most of the shares that we owned at $3. It's back to this de-risking concept. We're not buying something and saying it's really cheap. I think it's a 10-bagger. This has turned out to be a 10-bagger from the bottom at $3, but we were long gone in the sense of any meaningful holding by the time it hit $30. And they released their results last night. They had their call this morning. They actually had bad results. They actually guided lower for the rest of the year, but the stock went up. It's back to this idea of we don't try to predict prices. We simply react to whatever the price is in any given day. You can spend all your time trying to guess what everyone else is going to do. So again, not as significant as OpenText in the sense of because the share price hasn't been as volatile, but we've taken identify a great company, buy and hold would be great, improve upon it by de-risking the portfolio in the way that we de-risk the portfolio, in this case 44%. And in every case that has been anything above an average holding in our fund at any point in time in the life of our fund, this IRR has been better than a buy and hold. And that's why I said at the beginning, a lot of our outperformance, not all of it, but a lot of it is from this portfolio construction discipline. So I think that's probably not a bad place to stop for questions. Yes.
Very interesting, thank you so much. When the stock goes down, one of your holdings, you mentioned you buy more. Where does the cash come from, like if you don't hold cash?
So within a few percent, I mean, at any point in time, we might have a bit of cash. So today, our net cash is about 4 or 5%. But it comes from selling other things generally, because it's relative attractiveness. So this company, our second biggest holding, whose share prices continues to fall, we fund that by selling other positions whose share prices have not fallen. Now, I would describe it, there's an overlay. I'm pretty careful to look at, if we're selling that company's share price, did we pay a higher price for those shares, like on a LIFO basis? So there's a bit of an anchor of, we're not so convinced that all of our values and all of our forecasts are right. This is back to the idea of uncertainty. We don't want to keep changing the portfolio to lose money. But with 25 holdings and things moving around, even today, with the market falling and some of our holdings are declining, our biggest holding went up. And we were actually selling it because we already had planned to sell it. So it tends to get funded by the other positions. But on any given day, we'll have a bit of cash. And I don't want to give you the impression that these are epic moves. What we do is very incremental. It's very incremental. Think of every 1% price move. Our debate is we always do a little bit. I mean, you have to do a little bit. It's almost a blind. Of course, you do a little bit, but then maybe you do a lot. Maybe you do a medium amount. Maybe you do a lot, and we pre-plan it because the problem with deciding in the moment is that emotion gets involved, or I'm on holidays, or somebody's not in, and instead you sit around at a time when everybody's calm, and you put up a stock chart, and I have this discussion all of the time. Years ago, my partners didn't like me saying this, and I'd say, well, so with TransForce, okay, it's $25 today. how much will we buy if it went to 20, 24, 23, 22, 20? How much? And they said, well, you know, that's silly. It's not going to go to 20. I said, well, how do you know it's not going to go to 20? And so we'll pre-plan it. It doesn't mean we blindly follow it, but it gives us a guidebook for each of our holdings. And now, if everything falls by 10%, so think of 08, the fall of 08. For us, everything went down 10, 15, 20%. We didn't do anything other than selling OpenText. We didn't go down. We don't have to do anything. If there's a severe market correction in the next few weeks, could happen, we won't do anything. But in an environment where one of our holdings is falling because the U.S. shorts are shorting it, and they don't know what they're doing, and they don't know what they're doing, in this case, we're happy to buy more. And we'll fund it with a company that's not in the crosshairs of the shorts, and it's just trading at an all-time high, which is what we did today.
Awesome presentation, thanks very much. One of the knocks on trading more actively versus buy and hold is the long-term negative impacts that transaction costs and taxes can have on portfolio returns. How do you think you guys have managed to avoid those pitfalls in your return?
So on the tax side, it's we haven't avoided the pitfall. The pitfall is we do trigger gains sooner than a buy and hold. There's no question. And when we started the fund, and I wrote some called founding principles, which you can see on our website, we have 6, but we had some sub-founding principles. And one of them was, we're not going to worry about tax. We're not going to hold off on what makes economic sense to defer tax. Because we think that our approach adds so much more value than the deferral of tax, because ultimately you're going to pay the tax. So our taxes get triggered sooner than a buy and hold, for certain. However, and you may get the impression that we're trading, and I did say we're trading every day, but it's incremental. So last year it was 35% of the fund turning over. In the credit crisis, it was 100 in a year, but we weren't booking profits then anyway. So think of it as over a 3-year period, we might turn the portfolio, and that is earlier tax than a long-term buy and hold. So that's absolutely the case, but as I said, we think that we've done after-tax calculations. It's pretty small impact. The transaction costs, firstly, as any institutional stock trader will tell you, they're trivial. I mean, they don't get paid much, and we believe we get terrific execution and research that more than justifies the couple of cents we pay. So the actual commission cost is trivial. The transaction cost, the activity in the market, if you think about our approach, there's no friction costs. We're the people on the bid all the way down. We're not saying, hey, let's buy some more of TransForce. Let's go buy it. Yesterday, before the results were released, we were buying stock because it kept going down. And our trader, at RBCDS in this case, one of the Canadian firms, knew how much he was going to buy at various prices, and they're really good at it. They don't hold it up. They kind of let it come to them. So there's no friction costs or transaction costs that way. And I thought, honestly, at the open we're going to get to buy more stock, because the results weren't, not only the results were kind of mediocre for the quarter, but he guided lower for the second half of the year. But in fact, the stock went up, so we didn't get to buy more. We're only going to buy as it's falling. We're selling as it's rising. There's no transaction cost on that. Yes?
Could you talk through your sale process with regards to exiting positions?
So,
the discipline on the sell side.
Well, we exit because prices go up. So if TransForce, no matter how much we love this company, as you can tell, if the price of this company went up to here,
okay,
we'd actually own a little bit, because if it's on that blue line, you still have an expected return of about 9.5%, and it might be 1% of the fund rather than 8%. But if it keeps going up, at some stage, we won't own any of the company. So that's one exit, which means that we fully expect to come back in. If you think of OpenText as the previous example, when I meet with management, we'll tell them we've been a shareholder for 15 years. I made my mistake with this company. I sat down once at dinner with the former CEO of this company and said, hey Tom, look at this, isn't this great? Look at this slide. And he harumphed when he saw this. Because, of course, what he was thinking is, you didn't own us in the credit crisis. Now, logically, a CEO would say, well, that's great. You're buying when nobody else wants me, and when everybody loves me, you're out. But no, they do want to know and believe that you're a long-term shareholder. And so we don't talk about this with our companies. So that's one way that you come out of a company with the full expectation that you're coming back in when the price falls. The second way is that we think we found better companies. That 4 a year where we add 4 and push out 4. A lot of those companies, they're never coming back. We found better companies. So it's a bit of two different things.
Thank you.
Yes?
You mentioned that the discount rate that you use typically is 9 to 10%. I want to see if you can expand on that in different economic environments and different industries. How you do that.
So the one caveat I would make from a financial theory standpoint is we then, in our portfolio construction, we have a factor that we call dispersion of value. So you can think of it as you've got a forecast, what's the range of outcomes of that? You've got your median guess, and then you recognize, look, the world's uncertain, what's the range of outcomes? It can have a big effect on how much we want to own. And we once last year calculated mathematically that it would have the same, roughly the same impact if we used an 8 to 12% WACC. So rather than 9 to 10, think of it as expanded 8 to 12, like a much bigger band. So, and because we don't own early stage mining companies and biotech companies, and we also don't own utilities, I think that range would capture the riskiness range of our companies. So that's the answer in terms of trying to benchmark against all of the companies. Call it 8 to 12, that's a big range. The second question, which is not reacting to changing interest rates, is what I said earlier, it doesn't matter. I mean, I recognize that in the first part of my career, I was an M&A person in an investment bank, where I used to talk about weighted average cost of capital with companies all the time. But we're not investing on an absolute basis, it's relative. So we could shift our discount rate to 7%, or we could change it to 12, and it would have very little impact on how much OpenText we own, because the value of that blue line would come down or up based on the discount rate, but so would all the other lines, blue lines of intrinsic values of all the companies that we own. And so all we care about is trying to be consistent in our forecasts among our 25 holdings. And then the other absolute test, if you will, when we have a portfolio that we think is going to earn 15%, for the next 10 years, compounded. We don't want to be in cash. When we were in 2000, that number wasn't 15%, it was 7 or 8%. And interest rates were a lot higher then than now. And that's why we in fact had over a third of the fund in cash. So that's our way of dealing with weighted average cost of capital, discount rates and things. Yes?
I know you said you don't go out and look for a specific company in a specific industry, but I was just wondering if you could tell us what kind of companies are you do end up investing in, just based on how you're running your shop.
No, it's a good question, and we don't think this way, but then when I write quarterly commentaries and annual letters, and we write the Tao of the Turtle, and so we kind of look at, is there a theme, are there thematics of the companies that we own, beyond just this tagline of highly intelligent organizations. So some of the commonalities tend to be long time management tenure. Now, there are exceptions. We own a company that when management changed, we took a look at it because we knew new management and ended up owning it. So that is a common theme. Stella Jones, long time management. And often those managers, even though they've been there a long time, if you sit down with them, you come away thinking, they're just getting started. They have a lot more ahead of them. Another common theme would be rational big ambition, or large rational ambition. Global companies having an opportunity globally. And I always stress rational, because you can have big ambition and blow up. But I would say most of our companies have big ambition. They have an opportunity, they know how to do it, they're going to get bigger. OpenText has done that. TransForce, as a transportation company, has rational big ambition, but it cuts both ways. On his conference call this morning, the CEO of TransForce said, I don't know. I mean, if I may sell this division. Look at where I'm trading, and he's very focused on shareholder value, and ultimately he's not going to do this forever. So that's another theme. A further common feature, not always, is our companies are very good at acquisitions. You know, and I think I was taught, and I think it's true, most companies destroy value when they buy companies. And I think maybe it's our backgrounds, but we, I think, are able to identify the minority of companies that are good at making acquisitions and creating value through acquisitions. OpenText, huge value creation. And the analysts hate the fact that they don't have enough organic growth. At the end of the day, since we're cash flow focused, I don't care where it comes from. We own a company in the US who is in the aerospace parts business. And we haven't known it for long, and it's not a big holding. But what I love is my partner came back for a meeting with him in Florida, and he said that the CEO's comment at the point was, I'd sell paper clips if it made cash. And, you know, it was a bit of a silly statement for a guy who buys small aero parts companies and sells to airplane companies. But his point was, I'm just trying to generate cash. I'm trying to make money. So that's a theme of, I think, the companies that we look for now.
Last question.
So your process is that every year you identify like 25 companies, and then you add like 4 companies you think which you want to update your like watch list, and then you get a price for every company in the very beginning of the year, and then when the stock price crash or it change, you adjust the portfolio. What I heard is that process. And normally when there's earnings or something, when the stock price fluctuate a lot, and most of the company like in the US, they will do a lot of research why if the company like go up and down within 10-20%, within a few days they will see whether fundamentally the company has changed. And from what we heard from you, that you have confidence that when the stock price fluctuates dramatically, you don't need to do further research. You just adjust your portfolio. So how you can get this confidence comparing to the Wall Street?
That's a great question. So we learn what we do from the companies, that we talk to the companies. And so you have to believe when you speak to a company that they're telling you the truth. That's a critical, and that's a filter that we have. So if you take OpenText as an example, I would make the statement that in the history of our fund, I mentioned we've owned 10 US companies, but then add the companies like OpenText. It went public in the US, it didn't go public in Canada. This price action is driven by Americans, not by Canadians. If this company had gone public in Canada, this never would have happened. And this never would have happened. The American market is wonderful in that there are so many momentum traders trying to jump all over any piece of news. We believe that value changes very slowly of a company. So there's no informational content in shares going down 20%, is what I said earlier. There's rarely such news in a quarter that would cause us to change our view on a company. A little bit, but rarely a lot. And so we don't think that the market going down 20% is telling us anything. And that's how we act.
Okay, now real last question.
Just with your valuation models, do you use a discounted cash flow analysis? And if you do, what do you do with the terminal value?
Right.
And how far out do you forecast?
So in terms of our models, it ranges. So our view is, so we do use it, we absolutely apply terminal value. I would describe it mathematically as every one of our forecasts are perpetual. They go on forever. But if you understand discounted cash flows, if you go far enough, it doesn't matter what the cash flow is. So what we do is once there's no better assumption to make than static assumptions, GDP growth, whatever it might be, then that's when we apply a terminal value. But I always want to make sure that mathematically it's the same as if we had simply at that point continued out for 50 years at constant assumptions. And so really, in a way, all of our forecasts are perpetual. Some of them, at 10 years, we go with perpetual, flat. Some of them are 20 years. We own some companies that we think have a very long, above average growth, above GDP growth. Now, in the later years, there may not be much above GDP. And we have other companies that, I should mention, I think I did, that we own companies that are shrinking. It's okay. I mean, it's okay. As long as the management of the company realizes that they're in a shrinking industry and they manage for that. Because again, for us, it's all about the cash we're going